Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and I'm coming to you today from the Lanai outside my house in Sanibel Island, Florida. Now that the weather is improving in the north, I think I can come outside and shoot the video outside. I want to talk to you a couple of things today. One is a continuation of discussion about the issue in Cyprus. Let me try and help you understand at least my perspective. I believe, and I know these are harsh words, but I believe that the Cypriot government lied to the people. And I mean they lied because they just didn't discover all of a sudden one day after the legislation had passed that they were going to need to take 60% of the deposits out of the banks in order to deal with their problem. It's interesting how we started out, it was going to be 6 3/4% on the accounts under 100,000. Then it was going to be 9 3/4 for accounts over 100,000. Then you couldn't touch the 100,000 euros. So then it went from 9 3/4 to 20 to 30 to 40. And after the legislation had passed, the government came out and said they're going to take 60% of the money in deposits. Now, the latest report that I saw was about $32 billion was subject to this 60% recapture on the part of the government. Here's the problem I have. The European Central Bank said that they were going to use this particular method that they used in Cyprus, perhaps in France, perhaps in Spain, Portugal, Ireland, Italy, or wherever they needed to. What was extremely important to the European Central Bank and the International Monetary Fund was the reaction of the Cypriot people when they announced it was going to be 60%. You may have seen the story where there were film crews in the central plaza filled with film crews waiting for the people to march on the city to protest the 60% takeaway of their secure deposits in the banks. Nobody showed up. I think that that sends a tremendously negative message to the rest of the world, that now that nobody really protested taking 60% of the deposits, over 100,000, everybody in Europe is now scrambling to try and figure out where they're going to put their money, taking it out of banks in excess of 100,000 euros, whether that's individuals or corporations. You've been put on notice that we're going to go after the deposits in the bank beyond the principal guarantee, like our FDIC. And since nobody objected, nobody protested in the streets, nobody hollered and screamed, nobody burned anything down, they just accepted it, it sends the wrong message, in my opinion, to the European Central Bank leaders. And as a result, they're going to do this every time they get a chance. Now, I think that the Europeans across the Central Europe area are basically smart enough to figure out that this government's going to do this again and again and again. So they're taking their money out. They're looking for a place to go. What clearly happened after that 60% number was released, short rates in the United States couldn't hardly go much lower than they were, so they were so close to zero. What happened is that the long end of the yield curve, meaning 10 to 30 years out, collapsed. We had at one point in time the yield on the 10-year Treasury, a new all-time low at about 170, and we had the yield on the 30-year Treasury at 285, down from 325. Doesn't sound like much, but it's a huge decline. And so what happened is, since people were looking for yield, what happened was the people went out on the yield curve and demand exceeded supply, and when demand exceeds supply, prices rise, yields fell. On top of that, at the same time the European Central Bank is taking away 60% of the deposits, the Japanese Central Bank decided that they needed to reinflate the Japanese economy, which had been doing nothing for almost 15 years. So the yen collapsed as interest rates along the entire yield curve collapsed in Japan. And so what happened was the currency came under value. So where did everybody go? The Europeans who are fleeting the banks in Europe, and the Japanese investors who saw that the government's trying to reinflate paying them nothing and deteriorating the value of their money, everybody went to the dollar. The dollar is back as the primary currency in time of turmoil. I think that's probably going to continue because now we found out today that the GDP in France, this was recorded on Tuesday, the GDP in France for the last quarter was 0.1%. Now, it was below the estimate of 0.6% annualized. If you think about 0.1% annualized over 12 months, you can't even see it. So the French government is desperately trying to figure out how they're going to get their economy growing again. In fact, that's the secret across all these countries in Europe. How do we get them growing again? You don't get them growing again by taking 75% of the income tax on individuals' earnings and investments. You don't get it by taking 60% of their deposits. So this story is far from done. And while the dollar is getting significant strength against all major currencies, a flight to quality, if you would, I do think that will abate over time. Now, the American equity markets got a huge boost when the yield on the 10-year dropped below 2, as I said, down to about 170, and the 30-year dropped below 3. Now investors who have to put money to work are forced by the Fed, because interest rates have fallen again, to have to go into the stock market to try and get any kind of reasonable rate of return. So the lack of income from U.S. Treasuries and the demand for U.S. Treasuries because of the instability in Europe and now Asia has created demand for the U.S. Treasury securities, and the U.S. dollar has brought a collapse in the yield curve so that the spreads are much narrower. What does that mean? That means that mortgage rates will probably go down a little bit from this level. It means that certificate deposit rates are going to continue to go down. And so that people who are at or near or in retirement, who used to believe that certificates of deposits in money markets could help support their supplemental income, are getting no income from those investments. And what are they doing? They're being forced to make decisions about taking what we consider low risk or no risk money and putting it at risk in the stock market to try and earn any kind of return. The Fed has that under its design. Now, the Fed is still continuing to believe that it's going to keep interest rates low for an extended period of time. I think into 2015. We had an incredibly disappointing jobs number last Friday, about 88,000 jobs. Well, that's a disappointing number. The number that very few people talked about, which I thought was more disturbing, is that about 680,000 people in 1 month gave up looking for work. So while the unemployment rate declined, it's a mathematical fluke. We created 80-some thousand jobs in an economy that really needs 250,000 jobs a month just to keep itself level. I suspect that if we have another bad number for April reported in early May of below expectations on employment and job creation, I think this American equity market could be very vulnerable. We've come a long way, and we've all participated in our accounts. We've done very well in the first quarter, but nothing lasts forever. And so it becomes very important that we preserve some cash. It becomes very important that we understand that a correction's coming. I can't tell you when, but the higher we go without a correction, the deeper the correction will be. So I wish I had better news. We had great news for the first quarter, as I said a few moments ago. I think it's going to be a difficult year. I think jobs are going to be a problem. I think the economy is not going to get anywhere near potential, and that the government is going to be forced to reevaluate its expectations for GDP for the next 3 quarters. As always, if you have questions, please feel free to give me a call or send me an email. If you have friends or family members who are looking for help please feel free to give him my name or my email address. This is Dan Perkinson. Thanks for watching.